So guys, I want to welcome you again to the concluding part of our time value of money, particularly the payback period and the profitability index. That is a major thing for today. And then we'll briefly look at stocks and bonds, bond valuation, share valuation, stock valuation. We'll do more about stocks in subsequent times when we are applying all the machine learning models. Okay. So payback period is the time it takes for a project to recover from the initial investment. By the way, those of you who knows about taxi and Uber, about how much does one need to buy a taxi or buy a car for Uber? What is the approximate range? Those of you who are business owners, what is the approximate range?
Around 80K.
80K. You own one?
Yeah.
You have one, eh?
No, I don't.
Okay. So about 80,000, 80 to 90,000, that is it. So when you put in that amount of money, do you know approximately how much these Uber drivers or taxi drivers, how much they bring to their car owners monthly on average? Weekly or monthly, do you know? Yeah, moi. Do you know?
No, sir.
Okay. Richmond, you don't know?
No, please.
All right, so they are supposed to produce approximately 2,000 a month. Okay. So if we are to look at that 2,000 a month, forget about all other expenses, how long will it take them? By 1 year, how much would they have accrued? They would have gotten 24,000, isn't it?
Yeah.
So how long will it take them to get the 80,000? Or the 80, 90,000? How many years? 4 years.
Yeah, 4 years.
So you see how long it takes to get the Uber price back. So it is after that 4 years before you start thinking about profits, isn't it? So you see that there's a connection between the time it takes you to recoup the initial investment and the break even and then your net present value. So the payback period is the time it takes for the project to recover the initial investment. So in principle, that is a payback period. Now that is connected somehow to the profitability index, because the profitability index is the value created per dollar invested. Whatever you invest, the value you create. So when you take your net present value, you add the initial investment to it, and you divide it all by the initial investment, that becomes your profitability index. So you want to understand this thing. Why do we need them? Because remember, the goal is to either accept or reject a project if you can calculate these things. You want a shorter payback period. You want a shorter payback period so that you can say that I can go ahead. So if you have two projects and one is paying you a shorter time, the other is taking a longer time to pay back, you take the one with the shorter time. But when it comes to profitability, you want one with a profitability index, okay? One that is bigger than 1 and more bigger than 1, that is said to be more profitable than the one that is less. So the greater one, the more profitable it is. So we're going to use these ones to do an analysis in Python in Jupyter Notebook to see how practical this is. So you have this question with you. A company wants to evaluate two projects, Project A and Project B. Each project requires an initial investment of $50,000, generate a cash flows over 5 years. The company's cost of capital, which is the interest rate, is 10%. Question. This is a project. You can see that at the beginning, each project is costing 50,000. That is why it's negative. Compute the payback period for the projects, Project A and for Project B. find the profitability index, and compare and select the better one. So that's what we want to do. We go back to your Python code. Okay. And this is a Python code that you have here. So when you look at this, the same sort of question in example 23 is there. We are going to work it together. Now, first of all, you got to learn some few things on how to create a table. Okay. When you double click this, you see how I created a table. This is how you create a table. If you want the table to be created, you use these short vertical lines, which is on your keyboard. Okay, it's normally above the slanted division sign, the negative of the division sign. And you can use that to create a table. It doesn't need to be necessarily straight away, as you can see it here, but the table will be created automatically when you have entered, and it creates it nicely like this. Just so you know. Okay, so how do you now do this project? First, we import NumPy as MP. Okay, and then we create a function. Okay, so you can create a function all the time. We create a function that will calculate the payback period. This function is self-explanatory. We are defining to calculate a payback period. Okay, you could call it anything you want to call it, but so that it becomes clearer. And inside that, we need to have our initial investment and the cash flows. We need to have our accumulated cash flows. And then for a particular year, we iterate the process. Then we command that you should return the results for us, taking into consideration the initial investment minus accumulated cash flows that we have. And if the investment is never recovered, then it will return this command as well. We create a similar command for the profitability index. Okay, and that's it for that. Now, we can also use that same definition to create a command for the net present value. Now, remember that we already have the net present value, the NPF.PV approach, but I'm just creating commands here for those purposes. Take them one by one, and then it will help you to understand how these commands were created. So let's go to our analysis. Okay. Where is it? Okay, so just a second. Let me pull it out here properly so that you can see it. Okay. But you can be doing it alongside.
Okay.
So the first thing is to create the initial investment. Please, you see it?
Yeah.
You're supposed to type the initial investment. What was the initial investment? 50,000.
Yeah.
So you type your 50,000 here. And then the discount rate. What was the discount rate that was given?
10%.
Okay. So they call it cost of capital. That's another thing you should note. So you have 0.10. Let's define it as cost of capital. Then you come to the project. What was the first project? It was the values have been given up there. So these are the values. So you just bring this bracket and then just put the values in them. Okay, that's an initial investment, the negative. And then the others, you can follow them through like that. So please be typing that. Okay. I just did mine quickly. And then you can do for the project B as well. Type all the values in there. So the first one is negative And then the other ones, you have it all initiated. So we've created the cash flows for both projects. Then we compute the payback period. Remember that the payback period, we have given the calculation here. Okay, we have given the definition of how to calculate the payback period. So when you come to the payback period, you need to use that calculation. It was called, you can pick it here, calculate payback into bracket, blah, blah, blah. I can just copy it here. So come and drop it there. Calculate payback into bracket. Okay. And we are going to change the initial, because remember, it says that initial investment and then the cash flow. So the initial investment, we have a negative value. So we are going to just, and we have defined it already. We have defined it as payback underscore A for project A. So we are going to say that, let's call it absolute value, okay, absolute value of project A. So I'm going to pick this project. Absolute value of this project A. And then I will indicate that you should pick the values from, it includes the initial investment for the first one. Okay, that is why we have the 0 for all those that are negative. And then you do the same thing for project A, but this time we are not doing it for the negative, but we are doing it for the positive. So we'll not bring absolute value there. Okay. And then we'll indicate that that is for 1 all the way upward. So 1 column, everything else that is going upward. Because you can see that from here, everything going upward is that. So that is for project A. Now for project B, you can come and copy everything from here and dump it here for project B. And then you can change the A to B. Okay, the same thing because they all have negative 50,000 A to B. Guys, I hope you are following me. That's it. So that should calculate the payback period. Okay. I'm just putting all the answers there before we run it. All right, now we can calculate the net present value. So let's call it net present value for the project A, net present value for the project B. How do you do that? Well, go up there. We have defined that one too. Look at this. We defined that net present value should be the cash flows and then the discount rate. So I'm just putting the formula there for you to see. Cash flows of the net present value, we have to do for project A and the discount rate. We've defined the project A already. So we just pick this one. That is a project A. Okay. Now the discount rate was actually defined here as exactly discount rate. So we leave that one there because it's the same definition we gave to it. Then we do for project B. You can copy the same thing here, paste it for project B, change the A to B. And then the B was not using a different discount rate. It was using the same discount rate. So that settles that. Now we are ready to compute the profitability index. And that one was also defined up there. Okay. Now go up here. Profitability index was defined as calculate PI. Then you need an initial investment, and then the NPV. So I'm just dumping it here and then editing. Calculate PI. Okay. What is initial investment? And then it's the same thing we had for the one here, for the payback one. It was absolute value of project A with this 0. So I'm just going to copy this one. That's the initial investment. Remember, it's just the initial investment, profitability. Okay, and then the other one will not be the cash flow, so it will rather be the net present value. But where is the net present value? That one will have been calculated already from here. So I just pick the net present value we would have calculated from. Just paste it. That's it. Now we can copy this same thing and paste it for project B. And change the A to B. Change the A to B. So this should calculate that. Okay, now determine the best project. So which one is going to be the best project? We can type something and say that. So in the determination of the best project, let's say that project A, so type project A, project A, the best project is project A. If the pi A, if this one is greater than pi B, okay, is pi A, that is if the profitability index for A is greater than the profitability index for B. And then it is an if condition. So you say else it becomes project B. So else everything here, if not, then it is project B. That is the winner. That is the one that should be selected. That's it. Now let's display the results and run the answers. So we're going to display the results. Let's put a sentence. Okay. So we can print the result. Sometimes you can just go and copy and print, but then it's nice when you put it in a sentence. I've done the sentences already, so I'm just going to copy and then give it to you, which picks on every one of them. Okay, I will explain if you need an explanation. So I say that print project A, okay, project A with a payback period of whatever the answer is going to be. Okay. So project A, its payback period is going to be this, comma, correct to 2 decimal places. That is why you have the 2F. And then it's, so whatever years is, let's say it's 10 years, it becomes 10 years. I've written the years. And then the net present value, a comma, a net present value of that is going to be whatever the amount is, let's say 10,000. So it becomes 10,000 correct to 2 decimal places, comma, and then the profitability index. Okay, let's say whatever it is, let's say the profitability is 3 years. Oh, sorry, 3.7. Then that one too will show. So you should print that for project A. That's the first one. Print it for project A. And then print out the same thing for project B. And this is the interesting part. The best project based on the profitability index is best. So this sentence is going to read as the best project. And I've just brought this tick here. If you want, you can remove it. Okay. The best project based on the profitability index is whatever the project is. And we have indicated which one would have been the best, whether it's project A or project B. So based on this, the answer will be selected automatically. Good. So now we are going to execute the command. Hopefully, everything will work out. Let's run and see. This star shows that it's running. Okay. So you see the bar operator for absolute list. Sometimes you may get a couple of typo. So absolute list, which one is that?
ABS.
ABS with the list and then MPV. That's the first time we wrote it. Oh, it's up there.
Yes, up there. Yeah.
Let me be sure whether we wrote the correct thing. But if you are following me, yours might work. Remember yesterday we had a couple
Hello,
of,
sir.
yes. Okay, so perfect. So it should be fine. Excellent. So it means you have been working. Who was talking? Was it Linda?
Please was a Rabna.
So you have been working. Or you weren't working.
Please, I was working.
So you got your results.
Yes, please.
Okay. So I will always let you be mentioning your results. Good. All right. So that gives you the 2 projects. So based on this, which project should be taken? Based on the results, you notice that project A is the one that has to be taken. It has a bigger net present value. It has a bigger net present value of 9,213. It has a profitability index which is higher, which means it's more profitable. And it takes a shorter time period to recover the initial investment. Okay. And this interpretation, I've already given it to you here. Okay. So project A recovers its investment in 3.4 years. B recovers in 3.7 years. Shorter payback is better for project A, is preferred under the other one. Okay. And you can see that the key takeaway, project A has a faster payback period, more profitable. B has a lower payback period, therefore it creates less value. If the net present value and the profitability index are primary criteria, you will notice that project B should be selected. Let's see that. If you go to, no, that's not even the case here, is it? That's not even the case here. Project B. No, that's not the case here. In this context, no. So just so that you know, but that's not the case here, so that you don't get confused there. But that is the way you got to analyze it. The key point is understanding the principles and then projecting these principles. Now, when you are deciding on a project, you can see the net present value is being used, profitability index is being used, payback is being used, modify IRR, and then, internal rate of return itself can all be used before you come out with your final conclusion. All right. So that's it. That is how you attack this thing. Let's go towards the final part of our work, and that is bond valuation. Bond valuation. What is a bond? What is the difference between a bond, a stock, a share, and all of those things that you have been hearing? Now, if you know about them, it's great. If you don't, we have a little bit of introduction to bond valuation here. A bond is a fixed income. It's like a loan from an investor, you, the bondholder, to the borrower, usually the government. The government is borrowing money from you. The borrower, which is the government, agrees to pay you an interest, which is called coupons, periodically. And then they'll give you back the face value, which is the principal you give them, if it is 1 million, when it matures. Now, as far as you know, in this country, what are the different periodic bonds that we have? If you have been listening to the news, so what are some of the periodic bonds that we have? What are some of the duration?
Treasury.
Yeah, the period.
Please, I'm not sure.
Oh, who can tell us? What are some of the periods we have? Godwell.
Okay, for 10 years, 20 years.
So you people are not investing in bonds, eh? You people are not creating wealth. So nobody here is investing in, okay, but you're investing in treasury bills, right?
Yeah.
Which of you is investing in treasury bills now?
Sir,
Who is talking?
so this said, sir, we have 91, 180, and then 364 treasury bill, 365.
I thought you were going to say and 10 million.
I don't know if that's
Are you investing in any of them?
I've tried some before, sir.
Which one?
I've had experience with bond and then treasury bill.
So right now you're not doing any security now. None of them.
I think maybe some small treasury bill now, not bonds.
Why are you not sure of what you're doing now? Like maybe some. It's like your money is so much, so you are even confused where you have them.
Yeah, I receive it. No, sir. I think treasury bill, I have something because the duration is sometimes small.
It's
That's
not the
right, sir.
duration that is sometimes small. It's the money that is small. It's your money you put in that is.
That's it.
If your money is big, like some people's money, it won't be small. All right, okay. So okay, so what's the main difference between a bond and that of a treasury? That is a treasury, but what do you think is the main difference? Who knows? What is
From
the
what
main
I
difference
know,
between
sir,
a bond and a treasury bill? Yeah.
From the practical experience, I think with the treasury bill, you based on the interest rates. When the period is up, you get your principal plus your interest rate plus the interest amount. Then for the for the bond, I think they have periodic interest payments.
Okay.
Depending on the number of years. Then you get the interest, and then at the end of the period, you get your principal.
Okay, let's
say if I invest
7-year-old.
Yeah.
To a 7-year-old, one is long term,
Okay.
one is short term. Which one?
Bond is more long term.
Good. So bond is long term. Now, when it comes to the treasury bills, another way. One has interest, the other has no interest. Which one? Don't be confused there. One has interest, the other has no interest.
But say the payments you get on bond, is it not interest? Please, I just want to get clarity.
I've told you which one is interest and which one is not interest in the first place. So when you ask me the question, my answer is going to answer my own question. You know that.
I think, sir, they quote interest for the two of them, so they all have interest from what I know, sir.
Well, in principle, one has no interest. It just has discounted price. It's a price that has been discounted. Now, one has periodic interest. Okay, let me put it this way. Which one has periodic interest? Which one has no periodic interest?
So the bonds have periodic interest.
Yeah. The treasury bills does not have periodic interest. They just have discounted price. Because the treasury bills are sold at a discount to their face value. Okay, so in principle, they pay no interest. The investor will only earn the difference between the purchase price and that of the face value when it matures. But then the bonds will normally pay periodic interest, like coupon payments. Sometimes annually, sometimes semi-annually, plus that of the principal at maturity. Anyway, so now you know. So like you said, sometimes rich people go for the bond. And the bond will have more interest, or respectable interest. So let me ask you a question. So when you go to an analyst and you say that I have some money, I want to put this money down. I don't want to touch it for 10 years. Which one is he likely to ask you to go for?
The bond.
The bond.
All right. At least you're learning something. Okay. You're learning something. So one of the key features of a bond is that you have a face value, which we spoke about. Okay. The amount that is paid back at maturity, let's say 1,000. You have a coupon payment, which is a periodic interest. You have the coupon rate, which is annual interest at a percentage of the face value. You have the time it matures, or the expires, which is the maturity. And then the interest rate, the discount rate used to value the bond at the time of purchase. Okay, now, see, as a financial analyst, you got to have a fair idea of some of it. The key point is the price of the bond. What is the price of this bond? Well, the price of the bond can be calculated as a present value of the future cash flow. So if you want to know the price of the bond, its price is going to be the present value of the future cash flows. And it's calculated basically like this with this mathematics. We have seen this many, many, many times. Where the price is the P, the C is the coupon, the discount rate is the R, the face value is the F, and the number of periods until maturity is the F. Now, there are different types of bonds. The zero coupon bonds, okay, which is now moving you towards a sort of treasury bill, no interest payment. It is sold at discount. You have the fixed rate bonds. It pays constant interest rate. Floating, the interest rate changes with the changes in the market. Have you heard of the mark-to-market thing that they brought? Okay. Then the callable bonds, okay, can be redeemed earlier by the issuer. Then the convertible bonds, which can be converted into shares of the issuing company. Let's take a typical real-life situation. How about James Bond? So here you have Dr. No. Dr. No owns a bond. The serial number of the bond is 007. I like this question. 007. And it is issued by James Company. The bond pays $100 for each of the next 3 years, at which time it's retired, and it pays its face value of $1,000. You get questions like this all the time. How much is the James Bond's 007 worth to Dr. No at an interest rate of 10%? How much is it? How valuable is James Bond 007 if the interest rate has moved down from 10% to 5%? Now, here Mrs. Yes offers Dr. No $1,100 for the James Bond 007. Should Dr. No say yes or no to Mrs. Yes if the interest rate was at that 10%? Or what if the interest rate was at the 5%? So I think you all get a question. We are going to go to the solution angle, and then we analyze it. So this is your problem of the day. Okay? This is a problem of the day. I've given you the, oh, by the way, I hope you all understand the question. So the first thing you're going to do is to calculate, because you have to first, so how much, by the way, you got to understand whether this question is asking you for present value, future value, what. But there's a reason that you know that it's asking you about present value, because it says that the bond pays $100 for each of the next 3 years, at which time is retired and pays its face value. How much is the James Bond 007 worth? That word, how much is it worth? It's talking about now to Dr. No at an interest rate of 10%. So it's asking you of the present value of the bond. Now, how do you know that? Because the statement said the bond pays $10 for each of the next 3 years, means that it's telling you the future value. So how do you calculate the present value using this formula here, down here? How would you have done it? It's very, very simple. We've done this many, many times. You remember the formula? First, you import the NumPy financial as NPS, which is already there. We are calculating the 10-year, the 10%. So I've written present value underscore 10%. You have to use the formula. Who remembers that formula? It's NPF what? Now, Abner, you are the one who has remembering these things. MPF what? Dot what?
PV.
Dot PV. Now you put into brackets, you first write your what? Your rate, and the rate was what? 0.10. That was 10%. Then you write your NPR, the number of periods. In this question, what was the number of periods? 3 years. Then you indicate your payment amount, your PMT. In this question, what was the PMT? 100. Remember, it was 100 every month, every year. Then you indicate your future value. What was the future value?
1,000.
1,000. That's the face value. So you put that there. And then we have your when. The when is equal to end, as we know. So that one will not change. So what is going to be your result? Let's print it out. I want each one of you to do that. I'm going to put it in sort of a sentence. So let's print out, let me write it as a sentence where I say the bond price is going to be $, and then curly bracket, and then inside the curly bracket, I'm going to write, actually, I'm going to copy. I'm going to copy this, but you must have calculated it by now. I'm just putting my calculation in a sentence so that it sounds nice. And then correct it 2 decimal places. Then I can step out of mine. Yeah. What did you get?
Sir, please, sir, sorry, please. Please, do we have the notebook for this, or because in my notebook I don't have this question.
I sent it
It
this
ends at
morning.
the,
I sent it to you early then. Do you guys have something early days done? When you were all sleeping and I was awake.
this.
So just check it there, it's there. All right, so when you run this, let's see the results. Okay, so you have the results here. I think I've made an error.
Okay. The future value, maybe.
Oh yeah, it's supposed to be 1,000. Yeah, I could see that I made an error because technically it doesn't make sense. Yeah, and in principle,
minus 1,000.
yeah, so I will change this negative PV. I'll make this one negative PV so that the 1,000 the negative will go. Because it's a present value is leaving you, you are spending it. Okay, I attach that one here. So you should check the notebook you should have, and you should fill in this, you should have a similar result. So that is the price. So the present value of that payment, that bond, how much worth is that James Bond 007 to Dr. No? It's worth $1,000 to Dr. No. Remember, he was going to get $1,000 plus there are 100 other investments. Okay. There are other payments every year. And yet this year, today, is going to be worth $1,000. The next question is, how valuable is it when the interest rate is changed to 5%? So let's look at the 5%. If the interest rate, this very one, I could have not used this formula and rather use this. So if you look at this, I could have used a defined formula instead of the existing NumPy financial formula. Okay, that's why I've written all here, where you define the cash flows yourself. So if I define the cash flows myself, what would the cash flows be in this second one? If I were to define the cash flows, the cash flows will be, let me use this square bracket, will be 100 for the first one, okay, another 100 for the second one, another 100 for the third one. So that will be the cash flows. Then in my definition, the present value is going to be the cash flows and then the interest rate. Then this becomes the calculation, which I then iterate. So the present value at 10% is going to be that cash flow and then the rate. Okay. So it's because I've defined it here, I'll just pick it from here, like we always do. And then substitute that with a cash flow. And what was the cash flow? The cash flow was still defined as cash flow, so that's fine. The interest rate was defined as 10%. So I can change this and write 0.1. Okay. And I can have that. So let's run this and see. So the present value is going to be that. And then let me just ask Python to just give us the results. Okay, so I'm just going to run this. There's a typo, no. Oh, whoa, I made a mistake here. It's supposed to be, the last year will have the 1,000. Okay, watch it. Because the third year, there's a value of $1,000 after the retirement. Okay, you will have to pay value. So not just the 100, but then the 100 plus the 1,000 it pays. So when you run that, you should get 999.99, which is approximately the same 1,000 as this approach. So that is how you calculate this. Either approach will give you a present value of 1,000. Okay, now let's go to the B part. So the B part is here, which is the present value of the payment when the interest rate is this time 5%. So how would that work? Well, the same thing. This time I can just go and copy this, paste it here, because I'm doing for interest rate of 5%. I'll just do PV of 5%. Change this value to 0.05 because you are dealing with 5%.
Yeah.
Core 2 must be, one of them must be removed before you are penalized. Okay. And then we can just print. So let's just write print the results. So I'll just put this present value result here. Before you go to the next one, because the next one says, I mean, there are two ways of doing it. The next one is using the formula. So I can copy this whole thing. It's going to give you the same thing. Okay. So instead of that, I'll just substitute it with this. Okay. And then you have everything else as it is. 0.05 will have to change from here. Instead of the 10%, we are dealing with 5%. The number of period is still 3. You still have 100 for the PMT. You have 1,000 for this. Everything else is as it is. We change this one to 0.05. These two are the same. I'm just telling you. So when you run it, you see you get the same result. So the first result is when you use this approach. The second result is when you use that approach. Remember the second one, I've converted it to 2 decimal places. So that is it. Okay, so now remember when the interest rate is 5%, we get what? We get a higher present value. Okay. We get a higher present value. So the question now is, should Dr. No say yes or no to Mrs. Yes's if the interest rate is 10 or 5%? Now, what did Mrs. Yes say? Mrs. Yes offers Dr. No 1,100 today. Which one should he go for? I mean, just looking at it with your eyes before we even calculate. When the interest rate is 10%, should he go for it? When the interest rate is 5%, should he go for it? One of them is no, the other is yes, isn't it? Okay. So let's look at the offer price. So I'm just typing the offer price here. The offer price was 1,100. So down here, write 1,100. And then the decision at 10%. So when you go up here, the decision at 10% interest rate. What do you think the decision should be? It has to be yes, if a condition applies. But the question is, I don't know yet. So we just type yes, if the offer price, so let's type, if the offer underscore price is greater than PV underscore 10. Okay. If the offer price is greater than the one that you found. And as you can see with your eyes, it's more than that, but I'm just writing it. Else is no. Else is no. So in the case of this, when you run, let's see. Let's print the results. So let me type print decision. So I'll just copy this whole decision. When the interest rate is 10. And it's a yes. So the question was, should Dr. No say yes or no to Mrs. Yes if the interest rate is 10? Okay, you should say yes. Okay, because you have $1,000 and he is going to, Mrs. Yes is offering you 1,100. So you better take it. That's the whole point. You better take it. What Mrs. Yes is giving you is more than what you are currently having, which is 1,000. Now let's look at the second scenario. In the second scenario, the decision, I'm just going to copy the whole of this. So I'm going to change this one to 0.5 for the, and then change it to 0.5 if the offer price is that, and then if it is that. So let's print this second situation because we already have that here. We know it with our eyes, but we're just using that. If the offer price, let's type the correct thing. This is not supposed to be yes. I think I've made a typo somewhere. Decision is yes if the offer price, else is no. Did I run this? PV underscore. So what is a typo here? There's a typo somewhere. Because in principle, it's not supposed to be. Yes, because the second one gave more than the first. Which one is? Let's put it all together. If you put it all together, this command will put everything together for you. And it will even draw, it will draw everything to see the bigger picture. So let's run that and see. I decided to just put it all together. So here you can see that this is where Mrs. Yes offer is 1,100. That's a green one. Okay. When the interest rate is 5%, that is an orange one. When it is 10%, that is a red one. And we saw that when the interest rate is 10%, you should say no. Okay. Sorry, you should say yes, because you can see that the green, at that point, the green is bigger than the blue. The green line is bigger than the blue line. So Mrs. Yes offer is bigger than the present value, which is the blue here. But then when the interest rate is 5, okay, the present value is rather bigger than Mrs. Yes's 1,001, which is the green one. So at the interest rate of 5, okay, you should go for no. So everything is now imputed nicely in this graph, okay, which these commands will be able to nicely do it for you. All right. So that is how you do it. If you are told to draw a graph that showcases the point, this is it. Okay. So that is how a bond can be analyzed. This is exactly how you can go about analyzing a bond question. Let's look at the next one. A German.
Doc, if you want to go back to the previous one,
Yes.
the one we're getting yes and no.
Uh-huh.
Yeah, so if you run only PV10, you see an answer. If you run only PV5, you see an answer. So you notice that they're all negative.
Okay.
That suggests that whichever you use will be less than the offer price.
Okay. So
So unless you say is the offer price less than negative PV10, or the offer price less than negative PV05.
are you looking at the graph?
No, I'm talking on the previous one.
Uh-huh.
That the yes and no scenario.
Uh-huh. And what's your point? I want to know your point.
My point was that if you run only PV05 and PV010, there will be negative answers. So once they're both negative, without adding the minus PV, if you say this should the offer price be greater or lesser, will always be lesser because they're negative values.
Oh, okay, okay. You are talking about here.
Yes, please. Yes, please.
So what is your solution?
Okay. So maybe you can create another line.
Can't you edit it?
Yeah, you can edit just by doing minus PV10 minus PV5.
Yeah, we can just make it like that.
Yeah.
Yeah, okay. All right. So, yeah, thanks. So when you come to the third one, our time is running, so I want to just move faster now. A German government bond, okay, the bond pays $5, $5.375 annual coupon every year for 6 years. The par value of the bond is 100 euro. What is the price of the bond? Assume the interest rate is 3.8%. It's a very simple question. What is the price of this bond? So again, it's asking you of the present value. So you can use the present value analysis to get it. So once again, it's fairly simple. Okay, so we can say that the price of this bond is going to be equal to NPF dot PV to bracket the rate. In this case, the rate was given as 0.038. So you type 0.038. Now, the key point is that you should know that he's asking you of the present value because he said the par value of the bond is €100. What is the price of the bond? Okay, a German government bond pays this annual coupon every year for 6 years. So it's talking about the future. All right. So after the rate, the next one is the number of periods. NPER, the number of periods was given as 6 years. So you write 6 years. And then you are told that the payment, which is a PMT, was given as $5.375. Then you have the future value, FD, to be equal to 100. And then you have your when to be equal to 100. So this one, but the key point is that the key is remembering and noting that this is a present value question. So at the end of the day, you can print out the result. Okay. You can put it in a sentence. Sometimes when they always put it in a sentence, when you get used to putting it in a sentence, it's nice. So you have your F, and then you write the bond price. Let's give it a sentence. The bond price, column, dollar. Then you have your curly bracket. And inside that you can have, because we are dealing with present value, you can now write the present value, but in the negative terms. Then you can put that into decimal places. Step out and then write your close bracket. So this should give you, sometimes you get some typos, it's okay. So let's see. Even NPF print one price is I have my own typo. Print, but let me see. NPR, I wrote M. Okay, so that's it. So the bond price is $108 today. Okay. But remember that you're going to have this for 6 years. So the present value of this is going to be 1. And that is not bad at all. So you can see that the price will be $108.31 today. All right. Let's go to the next question, which has to do with, before I come to shares and then wrap up. The next question is about duration. See, it's not all the time you'll be calculating the present value, the future value. Sometimes you have to calculate the duration. So this is a 3-year 10 coupon bond with a face value of $100. Suppose that the yield on the bond is 12% per annum with continuous compounding. Find the price of the bond and its duration. Okay. Find the price of the bond and its duration. Now, remember, you are using continuous compounding discounting. Okay. Continuous compounding discounting. So these are your information. The value, there's a specific formula for calculating the price of the bond. You have the face value, which is 100. The coupon rate is 10%. The time to maturity is 3 years. The yield is 12%, continuous compounding. The change is 10%, from the interest rate. That is a 10 basis point. So you have this information. You can now use this information and create your formula. The formula you create, and I've explained this in the slides, the formula you create is known as the Macaulay duration calculation. So given this information, which you have, your Macaulay duration calculation is given by that. Now, let me just show you this in the slide so that you know how it is going. So this is the price of the bond. You use this formula because we are dealing with a continuous compounding. You use this formula to calculate the price of the bond. Okay. That is what you use to calculate the price of the bond. Now let's go back here. So that formula is the same thing I have imputed here. You see it has a sum there. It's the same sum here. Okay. I've used that entire formula here. Check it step by step and follow it through. So that will give us the duration, the continuous compounding duration. And then we can now divide this using the division assignment. Okay, you can use a division assignment to do this. Now watch it carefully. It is D underscore M divided equal to P. And that symbol is the division assignment operator. Okay, so it's like just saying that dm, okay, equal to dm divided by p. But instead of writing dm equal to dm divided by p, okay, that is why you've written it once. And when you do that, you will now be able to calculate the number of years. Okay, I got a typo here. It says P is not defined. It appears I have not defined P. Okay. 28. I have that one also in the slides. But before that, let's look at the difference between shares and stocks. I've written it here in the slides that you should learn it yourself, but just to give you an idea. A share is a specific unit of ownership in a company. Shareholders are entitled to a portion of the company profit, and this is called dividend. And they may have voting rights. Sometimes you have permanent and non-permanent shareholders. There are different types of shares. Common shares, okay, where the voting rights and dividends are not guaranteed. And then you have the preferred shares. That is not the same as a stock. A stock is general ownership in one or more companies. So the difference between the shares is that the share is like you have one company, whereas the stock, you have shares in multiple companies. So when you're a stockholder, you are getting, it's like you are owning shares in not one company, but in multiple companies. Okay. Sometimes people miss the two, but that is the main difference. The stock will still give you a dividend, okay, which is from the distribution of the profit. And you also have a capital gain. So you can sell the stock at a higher price to make a capital gain in there. We will look at this aspect of stock valuation properly, okay, when we come to stock price prediction. Okay. That's when we apply all the supervised learning techniques that we'll ever do. But the key point about share valuation is that you are trying to determine the intrinsic value of a company stock. How much worth is the stock? Investors will use that valuation models to decide whether the stock is overvalued, undervalued, or fairly valued. And they will use multiple things based on the earnings, the risks, the future cash flows, and all of that. Such valuation is good for investors to be informed and be able to determine if the stock is good to buy or not to buy. It can also determine whether we should have measures and acquisition and any other financial analysis that we should have. Now, there are several methods you can use. I told you that these are self-reading. That's why I'm moving fast. There are several methods you can use to do stock valuation. Number one is dividend discounted model. You have the price to earnings ratio, the DCF, the price to book. Okay, each one of them has been explained. And in fact, the dividend discounted model, I have a question on that here. Once you know the formula, you know the model, you can analyze it. And the question was, a stock is expected to pay a dividend of $3 next year. The dividends are expected to grow 5% per year indefinitely. If the required rate of return is 10%, what is the stock's value? So you're calculating the value of the stock. Use the dividend discounted model in Python and interpret your answer. So when you go to Python here, okay, that is a question. This is just the definition. This whole formula here is coming from the one you just saw. If you can remember, the one you just saw was price of the stock was on the left side. The current stock of the price was on the left side. Then that was equal to something divided by something. The numerator something was expected dividend the next year. The denominator was the interest rate, the required rate of return minus the dividend growth rate. So this R is a required rate of return minus the dividend growth rate. And what you see, which is the D1 here, is expected dividend next year. Now, if you look at it there, the expected dividend next year was given there. Okay. The required rate of return was also given. And then the GIN, which is the dividend growth rate, was also given. So if you were to use that formula to do the calculation, it's going to be a fairly simple calculation. We can say that you can write stock because we are trying to calculate the stock price. So let's say this is stock price of the firm, which is equal to the formula that you've defined above. Okay, so I'm just going to copy this whole formula here. The formula that you defined above, you paste it there, and then you indicate the D, which is 3. That was from here, $3. The rate was 10%, so you change this one to 0.10. The G was 0.055%. The R was 10%, that was here. 0.055%. And now you can print your results. You can just pick this one and just paste it down here, run your result, and you will know that the stock price is 60. If you check the slides, it's the same value that I have there. It's also still 60, the same price. So this one is fairly simple. What does that mean? The stock price is $60, which means that if the market price is higher, the stock might be overvalued. If it is lower, it might be undervalued. That's basically what it means. So this is the price of a stock. Price of a stock. That's how you calculate. Now, the next one is the same thing, but this time you are not using the discounted, dividend calculation, but you're rather using the price to earnings ratio. So it says a company has earnings per share of $5, and the industry price to earning ratio, industry, is $18. What is the fair price of the stock? Okay. Fair price of the stock. This is it. The way you define it, this one is the easiest way because you define the stock price to be the earnings per share multiplied by the price per earnings ratio. Okay. So it's just multiplication of the two. So there's a typical example that I've been given. The price is going to be the stock price per share. The stock price was $5. Okay. Then the price to earnings ratio was 18. That was given here. So you're just taking these two, which has been multiplied, and when you multiply, you can see clearly 5 times 18. That gives you the stock price value of $90. And then the final one, the company has a book value. So remember, all the 4 ways of calculating are what I'm giving you. Okay, here are the ones I'm giving you. The price to book value. Let me show it in the slides. Okay, you have it there. The price to book value is BV times the price over B. So the BV is the book value per share, and then the P over B is the price to book ratio. So this is the question. The company has a book value per share, which is a BV of $30. And then the price to book ratio is 2.5. So it's just going to be 30 times 2.5. What is the stock price? I mean, in your eyes, it's 30 times that. Okay. When you look at it from the Python, and you look at it from the Python, it's just a way of calculating this data. That will give you the final answer. So these ones are fairly cool. So you should check it on your like that. You should check it on your own. Yeah. So I have these two there, but they're also in the slides. So use the slides to be able to fill in these ones here. Okay. So guys, that brings us to the end of time value of money. We've looked at a lot of things within the time value of money. And so at this stage, all the things that you think that a person is undertaking in the bank or in an investment company, all of those things, you can take your time and you see that most of them, we've looked at it here. These are what they are doing. But majority of them do not even know how to use Python to do these things quickly. Some of them are easy to do. Some of them are using calculator, I'm telling you, to do some of these things, which is not great. But you have this knowledge. You have to master them. We just looked at, 50% of this. Master them practically. And you will see that these things are all doable. Some of you use this thing in your thesis, in your final dissertation. So it's nice for you to look at them. Next time we meet, we are going to look at classroom application in finance. We are going to be specifically categorizing or clustering people, investors, or profiling investors. Let me put it that way. We're going to profile investors. Sometimes you have 30,000 investors and you have to know what they like, but you can't know what everybody likes. So one thing you got to do is to profile them nicely. And based on that, so we'll use the principle of clustering. And there are different clustering methods. Have you guys been taught clustering? Have you guys been taught clustering?
Yes, please.
Fantastic. So which clustering method do you remember? Apart from K-means, because I don't want anybody to mention K-means. Please hold on.